I'm Sebastian St. James. There are some shares and ETFs that are far too risky for you, and I'm here to expose them. But to do that, we need to create a brand new metric that can measure all shares and rank them. Here is the MRR over the last 6 years. What's that? It is the Minrex Resources Limited. Well, it's certainly very wiggly. It's kind of a bit square. Is this a micro cap? I think it might be. It has returned 11.2%, right? So it's a positive return. The problem is that share is far too volatile. Volatile meaning you can't predict what it's going to be from one moment to the next. Here, take a look. On February 23, it was 13 cents. 3 days later, no, it was 4 cents. Wow. Jump forward to June, we're back at 10 cents. The problem with volatility is you cannot predict what you're going to get. This is Naomi Campbell. I'm sorry, but we can't see her legs properly. This is Naomi Campbell. Would you like to date her? You might think the answer is yes, but think again. Off the runway, this captivating cover girl lives a glitzy, glamorous existence, but eventually the fast life took its toll. For years, Naomi said she secretly battled and there's certain words I'm not going to say on YouTube, addiction. Then her infamous bad behaviour began to make headlines. Naomi's reputation took a hit when reports of phone-throwing, temper tantrums and other things surfaced. Today, Naomi says she's a work in progress and she's ready to reveal what's really behind all the anger. In the same way, you might see a hot stock and think, yeah, I want a piece of that. The problem is, you never know how that stock is going to treat you. Is it going to make you a tender, warm, juicy profit? Or does it just look good on the outside and in reality it's one psychotic, total, out of control train wreck? Sure, you had a good time while it lasted, but now you have a strange financial rash that you need to explain to your wife. Is there a way of discovering which stocks are too volatile, which ETFs are too hot for you to handle, no matter how good they might look? Yes, and today we'll create a brand new metric that will give us a new superpower. There are 2 types of risk. First of all, there is a negative expectation risk, which is really something going wrong with your company. For example, serious profit downgrades, your business model is being replaced by new technology, or your CEO is too hands-on with the female staff. These are real risks. They're nasty risks. And of course, they have a negative expectation. Your share is going down. The second risk is a volatility risk. Your share price is unpredictable, it may outperform, then crash by 50%, then rinse and repeat. The problem with volatility is that one day you want to retire. Now, you've run the numbers, you've done the math, and you know exactly what this particular ETF that you've invested all your life savings in is expected to return. The problem is, the very day before you retire, the ETF crashes by 50%, and you need to find a job for another 5 years. We know what volatility is when we see it instinctively. Here, take a look. Here is the HISAC versus the XJO over 20.6 years. The HISAC is the high interest savings account with bonus interest cumulative, which is that blue line that's got a very steady return. And the reddish brownish line is the XJO, which is the ASX 200. And instinctively we can see blue is nice and stable and predictable. The red line, well, that's all over the place, far less predictable, although it does outperform the blue. Interesting. What I want is a single number that crystallizes what we see and what we instinctively understand into one single number. So let's say an ETF has a volatility of 10. You might say, yeah, that's really nice, stable, predictable. Everybody's going to like that. On the other hand, this one has a volatility of 90. Oh dear, that's only very unpredictable and only people with a strong stomach should ever invest in that. If we created a measurement that did exactly that, then you personally could decide what level of volatility you're prepared to accept. Let's say it's volatility of 40, and then you only accept ETFs and shares that are below that number. If you're a bit more risky, then you can go up. It's up to you. But first, we need to create this volatility number. Otherwise, this whole idea is a pipe dream. At the moment, when I graph some shares, I then have some stats to go along with it. Take a look. Here's the HISAC and the XJO. Oh, right, the return, the total return over the period of time and the CAGR, the compound annual growth rate. So all I want is a third column there, one that gives us the volatility of the stock and allows you to decide whether it's too volatile for you or not. Right, to do that, firstly, we need to understand exactly what we're after here. So we want to measure how likely is a stock to deliver on the expectations set by its past returns. Or alternatively, how unpredictable is the stock in a quantifiable way, which is exactly the same as the first statement, except it's like 1 minus that. So how do we actually go about doing that? Option number 1. 52-week high minus the 52-week low. Oh, interesting. So here's a stock, for example. Over the last 52 weeks, which of course is a year, there is the lowest value that stock has been. Of course, it's the highest value that stock has been. And today, the stock is, well, it's somewhere in the middle, isn't it? So in theory, you could take the high number, subtract it from the low number, which tells you the range, which really doesn't tell me anything. I mean, stocks come in different prices. How about we convert that to a percentage? Right, so the delta is those two figures subtracted from each other. 177 minus 100 divided by 100 is 77%. Good. So there's been a 77% change over the year, but I don't know exactly when it happened. And did it actually just go up once in a nice steady line? Or was it like an octopus on roller skates thrashing around? Well, this particular graph, yes, more like an octopus, to be honest. So we need a different number. The range from the high to the low doesn't tell me a whole lot of detail. So how about we actually calculate volatility? Volatility is often calculated using variance and standard deviation. The standard deviation, of course, is the square root of the variance. Since volatility describes changes over a specific period of time, you take the standard deviation and multiply it by the square root of the periods in question, and that's your formula there. Well, that was fun. There is another way of thinking about this. Have you heard of a stock's beta or beta? That's really how volatile the stock is. Oh, it's got a high beta, it's got a low beta. What does that actually mean? Beta is often used as a risk-reward measurement, meaning it helps investors determine how much risk they're willing to take to achieve the return for taking on that risk. A stock's price variability is important to consider when assessing risk. If you think of risk as a possibility of your stock losing its value, beta is useful as a proxy for risk. Right, so how do we calculate beta? To calculate the beta of a security, the covariance between the return of the security and the return of the market must be known. Oh, as well as the variance of the market returns. Right, well, that's a problem right there. So, BHP, how volatile has it been in comparison to the ASX 200? That's the perfect example of when beta would make sense. But when we're trying to compare different asset classes, beta suddenly becomes worthless. Take a look at this. This is the HISCAC. Right, so that's Australian cash versus SPX, which is American shares, versus Australian shares. Well, they're not even in the same market. Cash in one country, shares in two different countries. Yeah, there's no market there to calculate any beta on. It's worthless. Do you know there's the VIX, which is a volatility index? Perhaps we can get some inspiration from that. How is the VIX index calculated? CBOE Options Exchange calculates the VIX index by using the standard SPX, which is the S&P 500 options, and weekly SPX options that are listed for the trading on CBOE options. Standard SPX options expire on the third Friday of each month, and weekly SPX options expire on the other Fridays. No. Sure, this is volatility, but this is all based on options. This has got nothing to do with what we want. Okay, I think we need to pin down exactly what we mean by volatility. In financial settings, volatility simply refers to the fluctuation of asset prices over time. All assets are volatile to some degree, with the prices they command moving around regularly in response to economic and other factors. We see this in all types of financial markets, like those for property, bonds, cryptocurrencies, and commodities like gold. Mathematically, volatility is captured by a share standard deviation of returns, which is a measurement of dispersion around its mean or average price. Calculating volatility. Oh, we've actually got the steps. Oh, it looks like we're going to actually do this. This video is now going to operate on two different levels. That's right. If you enjoy all the detail, I will quickly insert that for you. If, on the other hand, at school, your mind exploded every time you saw a formula, fear not. The bulk of this video will simply be a series of summaries which will summarize all the numbers. So you don't have to understand any of the formulas or numbers I give you, but you will automatically understand all my summaries. So step number 1, gather the security's past prices. Here we go. There's 10 days worth of data. The closing price was, oh, it's the same as the days. That's right. Day 1, it closed at $1. Day 2, it closed at $2, right down to 10, which is obviously a lovely straight line. I've chosen data for the supposed shares return based on a straight line because then we can intuitively know what the correct answers are, right? And so if this formula gives me something that does not match our intuition, then we know it's not particularly helpful. Step number 2, calculate the average price or the mean. Okay. Well, in Excel, I just use the average formula. And so the mean of that is 5.5. Very straightforward. Determine the difference between each price and the set of the average price. Okay. So I create a diff column and I simply subtract the closing price from the mean. It's straightforward. Step number 4, square the differences from the previous step. And here it is, 4.5 times 4.5, that's the square, equals 20.25. And you see all the numbers suddenly become positive. Sum the squares differences, right, so I simply add up the column, which is 82.5. Divide the squares differences by the total number of pieces in the set. Well, we had 10 numbers, so it is 82.5 divided by 10, which is 8.25, and that is the variance. Calculate the square root of the number obtained in the previous step. So the square root of 8.25 is 2.8723. So we have a set of data which is essentially a line sloping up. And then what this formula does is it actually gets an average right through the middle, or horizontal average, and then it figures out how far from the average each of my dots, my data is, and that actually gives me the answer. Well, that's all right. That's a kind of volatility, but there is a problem. When I take my straight line, my perfectly predictable line, and I make it steeper or less steep, this number actually changes. Is a straight line less predictable just because it's steeper? No, it's still 100% predictable. It's a straight line. However, the volatility number is in fact different. Take a look. So, of course, we started with the closing price from 1 to 10. Let's make that line a little bit steeper. So instead of adding 1 to the previous day, I'm going to add 2. Start off with day 1. 1 plus 2 is 3. 3 plus 2 is 5. 5 plus 2 is 7, and so on. It's still a perfectly straight line. It's still 100% predictable. However, the volatility is now 5.7446. That's actually higher, yep. That's right. Previously, it was 2.87. Now it's doubled to 5.7. According to this volatility formula, if your share, although it's completely predictable, it's a straight line, is actually going up faster than another share, oh no, you should stay away from it. It's more volatile. Is that what we're after? Definitely not. Therefore, this formula is useless to us. But wait, there is an alternative way of calculating more or less the same thing, but it's actually based on the differences in share prices from day to day as a percentage rather than the actual raw numbers. Take a look. So if I add 1 to 10, which obviously gives me 11, that's a 10% change. On the other hand, if I add 1 to 100, which gives me 101, oh, that's actually a 1% change. So they're not the same thing. That's right, real share markets of course work in percentages. Well, they don't really, they work in pure raw numbers, but we interpret them as percentages because they tend to grow by percentages over time. When a share is new, $1 growth may mean a lot, but when you're Berkshire Hathaway, $1 share growth means absolutely nothing. So let's take a look at the formula that will work on percentages rather than raw numbers. To calculate the intraday return by dividing each price by the closing price of the previous day and subtracting 1. So if I'm going to subtract from the previous day, I need a previous day at the very beginning. I start on day 1, so let me create a day 0. There it is. On day 0, the closing price was 0. In order to work that out, I need to divide the numbers minus 1. But no, that gives me division by 0. Error. Can a share price ever be 0? Yes, it can, but it does mean that the share's actually gone. You won't own that share anymore. It'll be worthless. So I better start on a number that isn't 0. Okay, on day 0, let's give it a value of 1. Day 1 will have 2, day 2 will have 3, etc. And down the right-hand side, there we go. That's actually the formula working out there. Interestingly, you notice the figure's actually getting smaller over time. So it starts off with a 1, and then a half, and then a third, and then a quarter, and then a fifth. Interesting. Does that look right to you? Well, yes, it actually does. Because we're adding 1, which is actually a raw number. But remember, 1 plus 1 is an increase of 100%, whereas 10 plus 1 is only an increase of 10%. So we'd expect that increase to get smaller over time because we're adding the same number in each case. Right, to calculate the standard deviation, I use the formula standarddef.s. Let me add that in, and that gives me a standard deviation of 0.277. Okay, but wait, there's more. Historically, volatility is usually converted into an annualized figure. So to convert that, all right, well, let's just do that then. Right, so you take the square root of 252 and then you multiply it by the previous figure. Got that. That gives me an annualized volatility of 4.401, which doesn't tell me anything. In the previous formula, we found that as we got a perfectly straight, predictable line, we just made it a bit steeper, suddenly the value changed. Will that problem happen again? Let's see, I'm going to add 2 rather than 1 this time. So 1 plus 2 is 3, 3 plus 2 is 5. I do the math, and the standard deviation, oh, it's different, 0.579. And a moment ago it was 0.277, yeah, it's like doubled. Right, we officially calculated volatility using 2 different methods, but neither of them give me what I want. A straight line is predictable no matter how steep the curve is, therefore out both of these methods must go. Look, all I'm really asking here is, if the Nasdaq, say, returned 14% per year, if I actually calculated that up in 10 years, I'm getting in a figure which I'm expecting. If I actually get to 10 years' time, how likely am I for the Nasdaq to be the figure which I calculated? Will it be roughly that, say, give 5 for 10%? That's good. I can plan my retirement. On the other hand, if it's gone through 4 crashes within that time, no, that's not predictable, and I may choose not to invest in it. That's really the measurement I'm trying to make here. In order to find this holy grail, there's another way of doing this. A secret way known only by high school mathematicians called linear regression. Oh goodness, what's that? It's a statistical method that allows us to summarize and study relationships between 2 variables. How exciting. Linear regression is the process of finding a line that best fits a data point available on the plot so we can use a predictable outcome for given inputs. Got it. Often we call this the line of best fit. Imagine that I've got a graph of data. Better yet, let me show you. Here it is, I've got some results, which are the green dots. I somehow calculate this linear regression, which is the line that perfectly goes right through the middle with the least amount of error. Once I've got the line of best fit, I can actually subtract the values and find out how much that error is. Now, this is linear regression. I'm fully aware that stocks actually do not grow linearly, but if I can actually put a line of best fit through a stock's price, then in 10 years, when I'm expecting the stock price to be this, and the line goes all the way there, and I can find out historically how much of an error it has been, I can get a sense of how predictable that stock's return will be. And importantly, does it fix my slope problem where a perfectly straight line is predictable no matter what the slope is? That we'll find out in a minute. All we need is 2 simple formulas. Oh, simple you said. M equals n of the sum of xy. Oh yes, Sebastian, you do this please. Fortunately, I understand the formula, which means in 5 seconds, so will you. We take the days and the closing price. Oh, they've got a little x and y. That's useful because that was in the formula. xy, well, that's simply those 2 figures multiplied by each other. 1 times 3 is 3. 2 times 5 is 10. X squared. Okay, so that's the day squared. 1 squared is 1, 2 squared is 4, 3 squared is 9, got it. Y squared, right, that's a closing price squared. 3 squared is 9, 5 squared is 25, 7 squared is 49, and I simply add them up there at the bottom. Right, there's that formula again. Now let me plug that in. Yes, you can see it in the spreadsheet, and M, which is the slope of the line, equals 2. Wow, it's a nice round simple number. What do you mean the slope of the line? Well, let's figure out how I actually calculated the data in the first place. Interestingly, what I did is I took the previous day and I added 2 to it, and the slope of the line is 2. Take a look. So we start on day 1, we add 2 to it, which is 3, then we add 2 to it, which is 5, and aha! The slope of the line is exactly the same as the number which I added to every single day. Got it! See, it's easy. So by using simple data, we can actually figure out whether the formulas give us the right numbers or not. Now, there's one more math equation to do, which I've magically done, and b equals 1. Well, what's b? b is where it crosses the y-axis, which is another way of saying when x equals 0. In other words, day 0, when we start the whole thing. Does that make sense that it should be a 1? Well, let's have a look. Day 0, oh yes, its closing price was a 1. So that figure is correct. So we're 2 for 2. 100% of this formula is actually making sense. Now I can predict the future. I've got 10 days worth of data. What happens on day 11? Well, you can have a look and figure it out for yourself, but using this formula, I can actually predict what the number is going to be. Let's do that. Here's the formula. Y equals mx plus b, right? We know what m is, the slope of the line. We know what b is, the intercept, and, well, that's just day 11. So 2 times 11 plus 1 equals 23. Does that actually make sense? Let's slot that in, day 11. It's predicted 23. Obviously, 21 plus 2, yeah, it's going to be 23. Aha! It predicted correct. In reality, and this may come as a total shock to you, share prices are far more volatile than a straight line. I know, total shock. But we're not trying to predict what the future price of a share is going to be. What we're trying to do is to stick a line through it, a line of best fit, and then say, how far from that line are the actual values? In other words, to figure out the error. And there's a way of doing that. Now we've got the line, which is what the math we've done so far is, we now figure out the error. And there's something called R squared, which gives us this result. All right, so R squared is the coefficient of determination. It's a measurement that provides information about the goodness of a fit of a model. And there's a formula there, which obviously I'm going to do for you. Do you know you can actually do linear regression in Excel by using inbuilt functionality? But ultimately, I have to program this into my graphing software, and therefore I definitely have to know how to do all of this by hand. I'm happy, but now let me prove to you that this formula actually returns the sort of results that we're after. Straight line data. Here it is. This is actual, oh, well, there's two lines there, isn't there, on top of each other. It is the regression line, which is the line of best fit. That's in blue. And in the dotted orange line, which is on top of the other one, it is the actual values. Right. R squared, which is how close the actual numbers equal the predicted numbers, is 100%. Well, yeah, I'd expect that. With the original formulas we tried, remember, I got a perfectly straight line, 100% predictable. I made it a bit steeper, 100% predictable. But no, the actual values change. If this formula, the linear regression, is any good, then the figures should not change just because I changed the slope of the line. So here's a steeper line. Oh, there we go. I've added 10 each time. 1 plus 10 is 11. 11 plus 10 is 21, and so on. Do the math, and R squared, oh, it's still 100%. Perfect. And there we go. The actual data falls exactly on the predicted line. Hooray! We finally have the holy grail here. No matter how steep the line is, it's always predictable. And this formula actually shows that. Now let's introduce a minor error. On day 5, what should that be? Oh, that should be 11, but I've changed to 14. R squared, or the match, is, 98%. Hey, that's pretty good. It's about right. And if I graph that, yes, I can see in blue the line of best fit. Red is the actual data, and it's slightly off, but yeah, it basically does fit the line pretty well. Now I'm going to introduce two big errors. Ooh. Day 5, which is supposed to be 11, no, I'm going to make that a 1. Wow, that's a big error. Day 7 is supposed to be 15, I'm going to make it 25. That is another big error. R squared, or how closely the data actually fits our expectation, is only 68%. All right, well, that probably sounds about right. Let's have a look at the graph. Ah, there we go. In blue is the line of best fit, and in red is the actual data, and yeah, probably 68% similar to the blue line. Now here comes the ultimate test. So far, if our data is perfectly linear, it actually gives a result of 100%. As you'd expect, it's totally predictable. On the other hand, if I give it completely random data, it should be completely unpredictable and give me something close to 0%, right? Well, let's try that out. So here it is. RAND, which will give me a random number between 0 and 1, to many, many decimal places. Day 1 is 0.084. Day 5 is 0. These are all random, aren't they? Yes. Go through the formula, do all the sums, and the R squared. Oh, it's 0. Exactly 0. Hooray! So blue is the line of best fit, which happens to be horizontal in this case. And the red, well, they're basically all over the place, showing that the line of best fit in no way correlates to the actual real data. Which makes sense because our data was totally random to begin with. Now keep in mind, this formula that we're using is not there to predict the future share price return. I mean, it could, but I don't know how reliable it would be. All I wanted to do is to compare different ETFs to each other. And I think this formula will give that to us. For example, S&P 500. How predictable is that in comparison to the ASX 200? That would be interesting. The NASDAQ, I'm assuming, is going to be a lot more volatile, therefore less predictable, but I want to know what the actual figures are. BHP, is that more or less predictable than Commonwealth Serum Laboratory, CSL? I don't know, we'll have to wait for those figures. But there's one step remaining. I have to now take all the formulas which I've created for you here and manually code them up in the programming language of the graphing software. But fortunately, we're out of time. So for the chilling conclusion, make sure you're subscribed to the channel and we'll show you in the actual graphing data software how predictable relative to each other all the different ETFs are. I'd like to see that. One question, however, remains in my mind. So far we've been doing linear regression. I can tell you for a fact that shares do not grow over time linearly. They tend to grow exponentially. Over time, the S&P 500 does not add the same actual dollar value, it adds about the same percentage. So 10% one year, 10% the other year, of course the dollar values are going up exponentially. Could it be that instead of linear regression, we need exponential regression? Yes, that's a distinct possibility, but we'll find out in the future. Working out how predictable stocks are is amazingly powerful. But the question still remains, if you do invest in stocks, how long does it take you to double your money? Click here to find out. Or if you've seen that, click here.